Welcome back to another explainer. Today, we're diving deep into the architecture of extreme systemic risk. We're going to be exploring a truly fascinating paper titled The Conditional Higher Moment Risk Measure, Second-Order Asymptotics with FGM Contagion. I was looking at this research recently and realized it completely redefines how we model catastrophe. It provides a massive structural breakthrough for handling extreme events. So let's explore exactly what these researchers discovered and set the stage for an incredibly detailed look at modern risk modeling. So here's the big question. How do we actually measure risk when multiple disasters strike at the exact same time? It's literally the ultimate nightmare scenario for any capital allocator. Imagine an extreme systemic crisis. We're talking a massive global market crash or concurrent environmental catastrophes. Standard risk models? Well, they're generally okay at handling isolated everyday events. But when massive shocks happen concurrently, those standard defenses can completely crumble. The real-world stakes here are massive, right? We absolutely need a mathematical framework that doesn't just guess at this concurrent contagion, but calculates it with pinpoint precision. Section 1. The limits of risk measures. To really understand the problem we're facing, let's talk about the regulatory frameworks that govern modern finance and insurance, things like Basel III and Solvency II. Standard frameworks rely heavily on something called value at risk, or VAR, and expected shortfall, or ES. But VAR has a massive blind spot. It completely ignores the severity of losses that happen beyond its specific quantile. It's kind of like knowing you might fall off a cliff, but having no idea how deep the drop is. Expected shortfall is a bit better, but it only provides the first moment of tail losses, meaning it offers zero flexibility to accommodate different degrees of risk aversion. Now contrast that with the higher moment, or HM, risk measure. By allowing us to choose a specific risk aversion parameter, the HM measure penalizes extreme events far more heavily. It provides this flexible adjustment for extreme losses that older, first-order approximations just can't match. But as we know, real-world risks aren't isolated. What the researchers found is that we need a specific tool to capture connected events, and that's where we get to the conditional higher moment, or CoHM. This is a measure of a primary institution's conditional tail risk given the realization of an extreme systemic crisis in a reference risk. The absolutely crucial point here is that CoHM brilliantly combines three distinct layers of information. First, the scenario risk level, meaning how extreme the reference event is. Second, the confidence level, which is the tail probability of the primary loss. And third, that vital risk aversion parameter we just talked about. Together, these capture an organization's true vulnerability to systemic, cascading shocks. And how do these shocks actually connect? Through what the paper calls FGM contagion. That stands for the Farley-Gumbel-Morgenstern dependence structure. Essentially, it mathematically captures a weak contagion between a primary risk and a reference risk. Think of it like a spillover effect. A massive event in one sector spills over into another, altering the tail distribution of the portfolio without necessarily changing the baseline expected losses. It acts as the silent amplifier in a crisis. Section 2. The second-order solution. Now, this is where we introduce the mathematical hero of our explainer. As the demand for precise risk assessment grows, first-order math is simply no longer enough to protect capital. First-order asymptotics are relatively simple to compute, sure, but they are highly inaccurate at extreme probability levels. They just don't bend with the data. Second-order asymptotics, on the other hand, are undeniably more complex to calculate, but they accurately capture both the tail curvature and that FGM contagion effect we just discussed. They don't just look at a straight line. They look at exactly how the line is bending as things get worse. It's a real game changer for modeling extremes. Section 3. Visualizing Frichet and Weibull. Let's really dig deep into the exact data charts from the research to see how this builds visually. We're going to start with the Frichet case. This represents heavy-tailed risk, kind of like a catastrophic Lomax distribution. Now, if we look at the chart plotting the calculated risk, the horizontal axis represents our extreme probability levels. These are pushing right up to 1.0, which is essentially the absolute certainty of a crisis. And the vertical axis shows the calculated CoHM value. There's a solid line representing the exact mathematically computed value. Just look at how meticulously the dotted line, which is our second-order estimate, tightly hugs that solid exact value all the way up the curve. It's a near-perfect match. Conversely, look at the exact moment the dashed line, our first-order estimate, completely diverges. It severely underestimates the risk right when it matters most. To put that into perspective, when we look at the chart measuring the ratio of these approximations against the exact value, the second-order ratio stays perfectly flat at the 1.0 mark. That proves its absolute accuracy. But the first-order ratio? It drifts aggressively downward. So what does this actually mean? Well, if you use first-order math here, you're structurally undercapitalized for a heavy-tailed crisis. No doubt about it. Next up, we have the Weibull case. This represents bounded risks, modeled here with a beta distribution. Bounded risk basically means there is a maximum possible payout or a ceiling to the loss. But why does a bounded risk behave this way? Well, even though there's a ceiling, look at how the data behaves as our horizontal confidence level pushes toward 1.0. Even with a hard cap on the loss, the first-order dashed line is noticeably detached from the exact solid line. It still fails us at extreme confidence levels. But the second-order dotted line, it stays totally unified with the exact solid line, providing a significantly tighter safety net. The ratio chart confirms this completely. The second-order model holds steady right at 1.0, proving it flawlessly accounts for the finite probability interaction of the FGM contagion that the first-order model entirely misses. Section 4, Visualizing the Gumbel case. The Gumbel case completes our mathematical proof here, representing light-tailed risks, like log-normal distributions. Now, you might naturally assume that light-tailed risks are easier to estimate, right? But looking at the data, the deviation of the first-order dashed line is stark. It massively underestimates the true conditional risk. The second-order dotted line, however, hugs the exact solid line beautifully once again. Let's focus closely on that ratio chart for a second. The horizontal axis is our extreme probability level, and the vertical axis is the ratio of the approximation to the true exact value. Notice how the first-order dashed line crashes drastically away from the perfect 1.0 mark. It is fundamentally disconnected at extreme quantiles. For light-tailed, weakly contagious risks, the second-order correction isn't just nice to have. It is absolutely non-negotiable if you want accurate measurement. Section 5, Real-World Insurance Contagion. To see how this all works in practice, let's imagine you are the chief actuary, or maybe an insurer who's responsible for allocating cash reserves for concurrent disasters. The researchers actually mapped these exact mathematical models onto real-world data. They used an Australian car insurance dataset, comparing claims between station wagons and sedans, to represent light-tailed risk. Then, they used the famous Danish fire loss dataset, comparing building losses to contents losses to represent heavy-tailed risk. This allows us to discover exactly how second-order CoHM performs out in the wild. In the light-tailed Australian auto insurance application, we see the real power of this math. Under an extreme scenario where station wagon claims spike abnormally, the model calculates the exact conditional tail risk multiplier for sedans. It's amazing because it tells the insurer exactly how much extra cash they need to hold for sedans when station wagons are crashing. Even in these light-tailed scenarios, the second-order asymptotics provide a much clearer, highly accurate numerical basis for independent capital allocation. Now, the heavy-tailed Danish fire application is even more dramatic. The math reveals that the relationship between building loss and contents loss is highly sensitive in extreme scenarios. Essentially, once a building loss reaches a catastrophic level, the contents inside are almost inevitably completely destroyed. This causes the COM to rise incredibly sharply. This dynamic completely alters how we understand commercial property risk. It makes an undeniable case for disproportionately higher capital allocations when underwriting flammable contents inside vulnerable buildings. Section 6, Redefining Systemic Risk. So, what does this all mean for the industry? Well, it means organizations finally gain actionable, highly precise benchmarks for differentiated regulatory capital allocation by utilizing second-order CoHM with FGM contagion. It allows for perfectly accurate pricing of cross-line triggered reinsurance, meaning reinsurers truly understand their extreme exposures. And because the relative risk contribution is scale invariant in heavy-tailed settings, it provides a robust benchmark that doesn't falter even when the math is stretched to its absolute limits. By incorporating this second-order dependency, we ensure we never underestimate the true overall risk of a domino effect. We've just seen, both visually and mathematically, that first-order risk measures drastically underestimate extreme concurrent shocks. The data is clear. If our math can now accurately predict and quantify the domino effect of extreme risks using second-order asymptotics, is your organization still relying on first-order defenses? It might just be time for an upgrade. Thanks for joining me on this deep dive, and I'll catch you in the next explainer.